JJ, the CPA here. Hope you're doing well. Welcome to JJ, the CPA's Small Business Toolbox.
The combination to money making, we got this. JJ, the CPA is the master locksmith.
Pretty cool. So this will be our first episode. We have Amanda back. She's doing great. We're going to be doing some graphics and some videos. And here's what you need to know. We're going to get better with time. So this is the first time we've done this live. Amanda's going to be coming in to help us put together this show for you as the producer. Welcome. Today, we're going to talk about a number of things. When we're talking about our agenda today, we're going to be talking about LLC or partnership. We're going to talk about, can you change your business structure after you start your business? When do you know it's time to expand your business? What's the best retirement for self-employed? And then an IRS alert. This no longer counts to prove expenses. Now, one of the things that I talked about was this will be in the first 5 minutes packed full of the answers to all these things. Then we're going to spend the rest of the time fleshing these out, give you some practical ideas and stories, be dealing with my clients. I'm a certified public accountant. I've been dealing with small business owners for 30 years now. So thousands of small business owners. I've got my own CPA practice. I'm in the trenches every day working with my clients, and I'm excited to be here with you today to try and give you some ideas as a self-employed, a small business owner, that maybe you can add to your planning, take to your advisors, expand what it is that you're doing. So in 5 minutes, let's walk through these things and then we'll expand on them. LLC versus partnership. So we talked about this in episode 1 last week. The partnership is a designation with the IRS. The LLC is, in essence, your designation with the Secretary of State. These are two completely different things. An LLC is your legal entity. You set up an LLC, a limited liability company, at the Secretary of State. You do not, at the Secretary of State, set up a partnership, S Corp, C Corp, self-employed, gig worker, you name it. At the Secretary of State, you set up your legal entity, and it's an LLC is where you would set that up. And then once you have your LLC set up, you're then electing with the IRS, how do you want it to be taxed? And one of those options is a partnership. So an LLC can be taxed as an S Corp, a C Corp. It could just file no separate return and reflect what is the activity on a Schedule C, a Schedule E, a Schedule F. Can be completely disregarded. So an LLC can be any of those things, including a partnership. So there really is no versus one or the other. It's an LLC, and you can elect for it to be a partnership. Now, let's talk about, can you change your business tax structure after you start? And the answer is yes. What you want to be mindful of is that you have two things working together with any business. You have a legal entity that is what I told you earlier. It's a Inc. You're incorporated. You're an LLC. You could be a limited partnership. Now that's still just with the Secretary of State. Anything else you're electing with the IRS. So if you are going to make any changes after you got your business up and running, then you also want to make sure that everything in essence works in coordination with your legal structure. So if you're an Inc. or an LP, you can convert at the Secretary of State your legal structure to an LLC, a limited liability company. It's typically in most states just called a conversion. Once it becomes an LLC at the Secretary of State, then you can change its, in essence, tax classifications. You bet there's forms to do it. This is probably not a do-it-yourself project. It's not anything to be scared of, because you just file the correct forms with the IRS to then say, now that I'm an LLC, here's how I want to be taxed. So it definitely can be changed, and you should look at it, because I'll tell you this, there's a number of things that have happened in the last 10 years, in the last 20 years, where it may make a lot of sense for you to revisit it and maybe tweak it. It doesn't mean you get a new tax ID number. It's just changing your structure. When do you know when it's time to expand your business? And I'm going to expand on this, as I told you earlier, but when you find yourself too busy as an owner, then it's time to bring on employees. That's a type of expansion of your business. If you find that you're dropping the ball on certain things, the quality of your product or your service seems to be going down, then that's probably a time to expand, as in you need to find additional vendors or additional employees, or you need to narrow down what is it that's making you the most money and expand on those things. But when you're talking about expanding your business, I want to talk to you in depth on, well, what are some of the things that you would want to consider when you are expanding business? But in terms of the time, when you're a small business owner, you're self-employed, many times you see the potential on the horizon. That's not the time. The real time to know when it is time to expand is when you can afford it, when the numbers are proven, when the cash flow is something that you know will be sustainable. So there's all these other things that are kind of symptoms of it, but that's when you know it's time to expand, is when you have a cash flow on what it is that you think you're going to expand on, that you know you can count on. And we're going to talk about why the banks would agree with that. That gives you some other solace that it might be time to expand. What is the best retirement plan for the self-employed? Now, self-employed would be Schedule C filer or a Schedule F. Now, some think they're self-employed, but they really own an S corp, but they employ themselves in an S corp, or they consider themselves employed, but they are running a partnership. When I'm talking about self-employed here, I'm talking about the Schedule C filer. And guess what? It's the same when we're talking about somebody that is also an employee of their own S corp. What is the best plan is, how much money do you want to put into retirement, as in a qualified plan, as in how much do you want to put in and get a deduction for? Many people start on the other end. Well, what's the best? I don't know what I should do because I'm not sure which one's the best. Guess what? The SEP, the simple, the 401k, the IRA, all of those things, it's a doorway that your money goes through. One of those is not any better than the other when you're just talking about, well, which one should I have? What you want to look at is, how much money do you want to put in? And then you pick the plan that allows you to put the most amount of dollars in. Well, what plan is that? Well, it really kind of depends on what the net income is of your business. Now, I don't know if we can bring up that graphic real quick for the self-employed, but when we're talking about the self-employed, we're talking about the Schedule C filer, that individual that has self-employment income. So as an example, if they have a net $50,000 and they're age 50 plus, well, they can put 25% into a SEP, or $12,500. They can put $27,000 in a 401k, $17,000 in a simple, or $6,000 in an IRA. So when I go into depth, I'm going to talk about each one of those, but here's what you need to know. All of these things yield a deduction going in, which means that it's going to be taxable when it comes out. It's, well, how much money do you want to put in? If you were going to tell me where I'm only going to put $3,000 in, then pick any of those. If you say, well, I really do want to put in $27,000, well, then you need to do a 401k. So what it comes down to is, how much money do you have to put into retirement that you then want the deduction for? So we can take that graphic down now. So what's the best retirement plan? A 401k, a simple plan, an IRA, 401k, if I didn't say that, or a SEP. Any of those work for the self-employed. Which one's the best? The one that will allow you to put the most money in. Well, which one is that? I just showed you. How much money do you want to put in? Then that's the one that you would pick. There's really no difference between any of them, because it's a tax deduction in, and then it grows tax-free, and then it comes out as a taxable income in retirement. And then lastly, IRS Alert. This is no longer something that counts to prove expenses. Now, this is an IRS alert that I tell my clients about and remind them every year about this time, which is this. Bank statements and credit card statements do not count as receipts. They don't. You have to have a receipt, an invoice, something from a third party to substantiate your expenses. The bank statement shows that your business paid for it. The credit card statement shows that it was charged. The business then made a payment to pay off the credit card, but it doesn't prove the expense. So you've got to have the actual invoices and the receipts related to that. Doubt that I did that in 5 minutes, but I'm working on it. Maybe what I need to do is not have 5 subjects, but right there is the, in essence, entirety of the subjects that we're going to go through now that we're into JJ the CPA's small business toolbox. Now, I told you earlier kind of my background. I work with small business owners. I'm working with them not only in their business, but them individually. And when we're talking about the LLC and the partnership, well, when does it make sense to be a partnership? So I'm now kind of expanding into our first topic of here. So when I'm sitting with a new client and they come to me and they say, hey, I've got this entity that I've set up. It's an LLC. How do we need to proceed now for tax purposes? Well, one of the first things I'm going to ask them is, how involved are you going to be in the business? Is this going to be where you're buying some real estate, you're going to rent it out and collect rent checks and fix toilets when they need to be fixed and pay the bills related to that? Is this going to be something that you're going to invest into another business, like directly? So you're going to invest $10,000 into a restaurant, but you're not going to be actively involved in it. You're just going to be an investor. Or are you starting a business that you're really going to be involved with it? You know, most likely I'd say, you know, are you going to be involved with it 500 hours a year, 10 hours a week on average? Or is this something that you're really going to be at working on expanding and selling? So really kind of those 3 main areas is what I'm going to be asking the client if I just literally don't know anything. So if you're going to be in a situation where you're going to set up real estate and you're just going to own it, right? Then a partnership makes sense. If you're going to be just what's called a passive owner is what I described to you as the second scenario, which is that you're just going to invest dollars. You're just going to put monies into something directly. So a partnership could make sense there. Now, you're right. Guess what? A partnership does require 2 owners, okay, for it to be a partnership at the tax classification level. So here's what I would first tell you is that if you don't have somebody that can be a second owner, which would be, let's say, your spouse or your life partner, your significant other that is legally bound to you, and you don't have that, well, then you can be an LLC that's a disregarded entity that's not a partnership. But I want to keep the focus in on, well, when does it make sense to be a partnership? Well, what I just described, and when you have somebody else that you're going into this with. Now, many times, if we have the partnership in play, we may find that it's 50-50 owners amongst spouses, or maybe it's 99-1 from the standpoint of liability or the effort that's going to be involved. I don't want to get too much in the weeds, but you do need to have 2 owners. But it can be as little as a 0.1% and a 99.99%. Just got to have 2 partners. Now, if you're going to be actively involved, I would tell you not to set up a partnership with the IRS with your LLC. I would tell you to be an S corp, because partnership, in my opinion, when you're talking about the taxation, it is really set up to be the best fit for activities that you're really not going to be heavily involved with. Real estate doesn't require a lot of involvement. Yes, if you have 5 to 10 properties, that might increase your involvement. When you're investing dollars, why would you want to do that through an LLC? Well, it gives you a liability protection. It gives you a layer to separate you personally from that investment into, let's say, the restaurant. You would own it through the LLC. So really, the reason that you wouldn't want to be actively involved in a partnership is that when you are actively involved in a partnership, then the net income of that business is subject to self-employment tax. Now, if you're actively involved, that's going to be something that's reported on page 1 of the partnership. If you're in real estate, it's on Form 8825 that's attached to a partnership return. But if you're actively involved in your partnership, that net income is going to be subject to self-employment tax. Now, I'm going to tell you this. There are many CPAs and EAs and tax professionals that they're either not in the know or they're deciding to ignore it, but there's going to be a pretty heavy body slam that's going to come into play at some point, because the IRS is going to be looking, in my opinion, keenly at partnerships. And if you're actively involved, if it looks to be the type of business that somebody would be actively involved in, then they may challenge to want to know, is that something that should be subject to self-employment tax? What's self-employment tax? It's an additional tax on top of your regular income taxes. It's a 15.3% tax. It's Social Security and Medicare. So if you're going to be actively involved, then you would want to be an S Corp, or if you're not going to make much more than about $20,000, you could just be a Schedule C, because the Schedule C is subject to self-employment tax, the 15.3%. Here's my point. Partnerships are, in essence, a great fit tax-wise for circumstances where you're not going to be actively involved because you don't want it to be subject to the self-employment tax. Now, the benefit of the partnership, and that's why I also feel like from a tax perspective, well, why wouldn't we just make everything an S Corp if we were wanting it to be a flow through? Well, the big difference between an S Corp and a partnership, and I understand I'm talking to you the difference between an LLC and a partnership, but hopefully what you heard me say earlier is an LLC is your legal designation, period, the end. An LLC can be a partnership. An LLC can be an S Corp. An LLC can be a C Corp. An LLC can be a Schedule C, a Schedule E, a Schedule F. It can be disregarded. So I'm really focusing in on, well, when do you want to be a partnership? Because you're saying, I get it. I want to be an LLC for my legal structure. So when do you want to be a partnership? And comparing it to the S Corp, another major difference or advantage to the partnership over the S Corp is that you can use the debt inside the LLC taxed as a partnership to get what's called at-risk basis. Now, I really don't want to get in the weeds on this, but I want you to know this. Many times in real estate and many times when you're investing into a business, in the initial years especially, and due to depreciation laws, you may find that you have losses. And to be able to take a loss, you have to have tax basis or at-risk basis. What does that mean? It means you have to have skin in the game. Tax basis is money that you put in essence. At-risk basis is, well, I didn't put any money in, but I did sign off on some loans. Now, you got to remember, we're on YouTube. I'm not your CPA as much as I'd love to be. You're going to need to visit with your advisors, because to ensure that you're getting this at-risk basis, you need to ensure that you're on the hook properly, that your operating agreement identifies what happens if the bank comes after you personally. Many will bow up and say, well, I'm a limited liability company, so they can't hold me responsible for anything. Well, that's true, but the second you sign on a loan to guarantee it or be a co-borrower, and you say, hey, I am going to be personally on the hook for this, then you're personally on the hook, regardless of the fact that it's in the LLC. You put yourself on the line, and if you put yourself on the line, you're at risk. That's the tax terminology. See, with an S Corp, you only are able to take losses to the extent of your tax basis, meaning money that you put in. You can also take it to the extent of money that you literally personally lend to the S Corp or to the partnership. But with an S Corp, you're not able to use loans inside the S Corp, even if you sign off on them personally, for at-risk basis. So the partnership is you're not actively involved. The partnership is you want to be able to have basis for the loans that you're signing off on. And when you're talking about a partnership, the biggest thing, especially when you're dealing with it as an LLC taxed as a partnership, is that you can have special allocations, which you cannot have with an S Corp. With a partnership that's an LLC structure at the legal side, you can have a different percentage of ownership that's different from profit percentage, loss percentage, how much money you have to put in compared to the other partners, which is contributions and distributions. What does that mean? Well, you could be a 50% owner in an LLC taxed as a partnership, but get allocated 100% of the losses. So I have clients that we do that with, where you have some partner that they've put the money in, the other partner's putting sweat equity in, they're 50-50 owners, but the partner that's putting the money in, well, they want to ensure that if there's any losses, they're getting 100% of that allocated to them. The profit is different from distributions. We simplify things and we think, well, I want to be a 50-50 owner because I want 50% of the profit. Guess what? With an LLC partnership, that can be different percentages, meaning I'm a 50% owner. I get allocated 75% of the profit, which means for tax purposes, 75% of the net income you're going to pay tax on, but I get 50% of the distributions. Why would you want to do any of that? Depends on who your partner is. Depends on what the circumstances are. So when you're talking about an S Corp, all those percentages are the same. An S Corp, if you're a 50% owner, you get 50% of the profit allocated, you get 50% of the distributions. You have to put in 50% of the contributions if there is a capital call, meaning it's one or the other, meaning whatever your percentage is, that's what you are for all things. Now let's talk about changing your business tax structure after you've gotten your business up and running. Now, what's interesting is that we here recently, I sent out on my YouTube channel on the community page, I did some polls and I was asking some certain questions. And one of the polls that we did was, how long have you been in business? And it was really surprising, and it's awesome, how many that are subscribers to this channel, you wonderful people, that have owned your business for more than 10 years. Even if you've owned it for a year or 5 or 20, you always would probably want to take a look at this, especially when we have major tax law changes or every 5 years. Now, it may just be that, yeah, your structure fits, but it doesn't make sense to just put your head in the sand and just assume that your structure is going to be a fit for all things. Because guess what happens over time? You have more employees. Maybe you become less involved in the business. Maybe you're a lot more involved in the business than you thought when you started it. Maybe when you started, you were able to put your own cash in, but now you find you're having to sign off on loans to be able to keep the business going. There's a lot of things that change with your business. Most businesses, the way that they start out at the beginning, when you look up 5 years, there's so many different changes that can come into play. So when you have major changes, it's also a good time to go, is this the best legal structure? Is this the best tax structure? And the thing is that my clients, when we talk about this, they immediately go to, well, I don't want to get a new tax ID number and a new bank account. Okay. We're not talking about doing any of that. I'm not talking about closing and ending a business and setting up a new one. So there's really 3 things that are going on here. What's your legal designation? What's your tax structure? And then you have an EIN, right? Well, no matter if you live in Texas or Oklahoma or Washington State, right? You're going to have a social security number. So it doesn't matter if you move from Washington down to Texas or over to California, your social security number is your social security number. So it's the first thing of those 3 that I want you to really remember, is that when you have a tax ID number, that's your business's tax ID number. If you change the legal structure, if you change the tax structure, it doesn't change your EIN. So you can put that all aside, because that seems to be typically, when I talk to my clients about this, their first hesitation to want to do anything related to this. But before you would change your tax structure, you may need to change or convert your business structure, your legal structure. So really, in most states, you can take whatever your structure is and convert to an LLC. Why would you do that? Well, because the LLC can be taxed as anything. So by starting with, well, I'm incorporated, I'm an Inc., or I'm a professional corporation. This is all at the Secretary of State level. So whatever that is for legal purposes, You can then typically in most states convert to be an LLC. Well, what if I can't convert to an LLC? Well, then you're stuck with whatever's allowed at the IRS for whatever your legal structure is. But there's more than one for any type of entities that we're talking about, a PC or an Inc. or a limited partnership. So if you can, in essence, convert yourself over to an LLC, now you have all options available to you with your tax classification. So let's just run through these really quick. I know that I talked about partnership a lot. I talked about the S Corp a little bit. But what are then really the main categories and why you would want to be one tax classification over another? It comes down to this: which one is going to yield you the least amount of tax? That depends on your involvement in the business. So if you are a Schedule C or a Schedule F, okay, you're filing this with the individual tax return. Well, an LLC can be those items. And if you're going to net less than about $20,000, when you take into account the costs of setting up and formalizing with the IRS to be an S Corp or a C Corp or a partnership, most notably having to do a separate return, you'd want to make sure that the cost doesn't outweigh the benefit. So you can go back and check out episode 1. Last week, I talked through that a little bit in length on the comparison of when to become an S Corp. But with a Schedule C and with a Schedule F, whatever the net income is, it's going to be subject to regular tax and self-employment taxes. So an LLC that in essence is one owner is going to net $20,000 or less. The Schedule C or the Schedule F may be the best if you're going to be involved. Now, if you're not involved and you're doing real estate, then it would go to Schedule E on your individual return. So these are the 3 big schedules on your individual return where you're not filing a separate return. Schedule C is self-employed. Schedule E, page 1, is for real estate. Royalties also go there. And you have Schedule F, which is for farmers or ranchers. So if you're going to net less than $20,000 or less, that might be the fit for your tax classification. Now, if you're, as I told you earlier, you're just going to invest, you're going to be in real estate and it's high dollar, you're going to get in multiple real estate transactions, you have a partner, then a partnership may make sense. If you're actively involved in the business, though, then an S corporation would be your best fit, because primarily the biggest benefit of an S corp over the partnership, in terms of when you're actively involved, the biggest benefit of an S corp over Schedule C is that the net income is not subject to self-employment tax, which is this 15.3% tax. Now, when would you want to be a C corp? Okay, most likely you're not tuning into this show or my channel if a C corp is best for you. I'd love it if you are, but C corp is typically best for, we're going to have pretty quick more than 100 owners. We're going to be going out and we're going to be visiting with venture capitalists. We're going to bring in millions of dollars of investments. We're going to take this business and grow it, and we want to go public. And the reason you would not, as a small business owner, want to be a C corp is that that net income gets double taxed. Whatever that net income is, you're going to pay tax at the business level, and then when you pull money out, you're going to pay tax down at the individual level as the dividend. And even when you add the 2 tax rates together, you're still going to end up paying more tax. No small business owner that's doing $26 million or less should be a C corp. Just shouldn't be. So for small business owners, it's S corp, partnership, or self-employed if you're actively involved. Well, Schedule C, that's self-employed, and partnership, if you're actively involved, they're going to yield self-employment tax, so you should be an S corporation. So now let's talk about, when do you know it's time to expand your business? Now, we could look at it as expanding my business is more space, it's more employees, I need more loans. Those are usually symptoms of, is it time to expand your business, as in you have more business coming in, more dollars, more gross receipts, more customers. So when you know that, you have more customers, as in we know they're going to repeat. We know they're going to come back, which then leads to additional cash flow that you can count on. So when you know that you can count on a certain cash flow from a certain product or certain service to either duplicate with the next cycle, with the next quarter, or with the next year, then it may make sense to hire more employees or get more space. See, many times small business owners, self-employed entrepreneurs, and I'm one, I've had my own CPA practice for over 25 years. And really the clients I'm working with are just like you. They're small business owners, they're self-employed. But guess what? I think the underlying common factor is, for those that are self-employed, gig worker, side hustle, have your own business, small or big, would be you're an optimist, right? You're an optimist. It doesn't mean that if you're not a small business owner or self-employed that somehow you're not an optimist, but I'm just saying most small business owners and the self-employed, they're an optimist, as in I'm going to leave a circumstance where I don't have a regular paycheck. I'm going to leave an employer. I'm going to leave something that may appear safe to now go it alone, or to go it with a group of people with really no guarantees. That requires somebody to be an optimist. And an optimist usually can see where something's going to end up, right? So when I play golf with my clients, a lot of times I use this example when we're out on the course. And I say, listen, the key to planning is like putting. And whether you're a golfer or not, you would know this. When you're rolling a ball, so you have a ball sitting on the ground, whether it's a golf ball, baseball, basketball, soccer ball, you name it. Not a football, but a round ball. And you roll that ball, well, 1 inch out, it's not really that big of a difference on where it's ending compared to if it was completely to the right or left. It's kind of just really kind of in the same area. But you start rolling that ball and it gets 3 feet out from you, 5 feet out from you, 10 feet out from you. All of a sudden, that ball either is here, here, or here, with just a little bit of shifting for where it starts out. So when you're an optimist, you then go, whoa, I just lined the ball up right here. And I know that if I roll it, it's going to go all the way down this way. And here's the revenue I can count on. And so because I know that the ball is going to go that way, then I need to hire more employees and expand. Time out. Time out. Let's be optimist. Let's now assume that that ball is going to roll down that direction. But let the ball roll for a while before you go and sign another lease, before you hire more employees. You need to let it go to really make sure, yeah, it really is going that direction. Because you know that life isn't just sitting there on a flat surface. There's going to be ups and downs or a little bit of a curve that may not really be something you can see from the get-go. So when is it time? When your cash flow is something that's sustainable. Not, oh, I learned how we could sell fettuccine Alfredo and we can charge $9.95. So now let's go and open up an Italian restaurant because I realized I can sell a fettuccine Alfredo. No. Do you have now one restaurant where you're already selling that, and now you're so busy that you now need to expand that location or bring on more employees because you have an hour and a half wait? How do you know it's sustainable? When it's something that you can count on. What's a litmus test for that? Now, many small business owners, they're not for debt. They don't want to go get a loan. In part, they don't want someone looking over their shoulders, number one. Number two, they don't want someone else to tell them no. But the bankers that I work with, that my clients work with, sometimes a banker can be a good litmus test for you to know, is this really a viable idea, a viable expansion, if you will? Because if a bank's willing to loan you money on your expansion, your idea of how you're going to increase your business, you're going to need to prove something out to them. What are you going to need to prove? Cash flow. See, I talk about it in my book. It's on Amazon, JJ the CPA here. Take the top 60 questions of my clients, most that are probably listening right now. You've already got it. Thank you for that. But when you're now looking at what is the bank's primary goal? Many think, oh, it's to earn interest. No, the primary goal of the bank is to get repaid the money that they paid out. So how do they know that they're going to get repaid? It's not about friendship and they've been with us a long time. And in fact, it's not even about, well, they carry a lot of deposits with us. Because you can walk into the bank tomorrow and pull all the money out of your bank account and go somewhere else. What the bank's going to loan on is cash flow, and what can they count on for cash flow? And increased cash flow, or cash flow that's going to cover it. So how do you know? Well, it's then looking at the profit of whatever it is that you're getting ready to expand to see if there's going to be enough profit in this expansion to cover the cost of the expansion and to a bank to cover that loan. So having predictive cash flow that you know this is going to be something, not because you've convinced yourself, not because you've convinced your loved one, not because you've even really honestly convinced the bank, because you can present anything to a bank that would, in essence, convince them. You would need to know in reality, this is something that's going to continue to be viable, that then makes it worth it to go and hire more employees or open a separate location or find yourself going and expanding into a franchise, if you will. Now, I'll tell you this, I've been, as I told you, I've had my own business now for 25 years. And when I look at it, and take that graphic down, I'm going to go into kind of a story here. But when I look at my practice, and we might just need to open the doors because it's mighty hot. Amanda's over here wilting. We have the sun coming in. I don't know why the air conditioning, we did pay our bill. I don't know why it's not working the way that it's supposed to. If we put a fan on here, then you're going to hear the fan. And you may not be able to tell because I do put a little powder on my forehead that I'm burned. I'm feeling a little warm right here. But I want to tell you a story. When I started my practice, I was 25 years old. And actually this Sunday, May 15th, I will be celebrating 25 years of having my own CPA practice. So thank you to all those that make that happen. Now, I've been practicing for 30 years. But when I started my practice, I knew that I had a sustainable business because people need to have tax returns done, because I focus in on tax preparation and then the tax planning that goes along with that. Now, when I first started, I did bookkeeping, I did payroll, I did sales tax, I helped people install their QuickBooks, and I did tax preparation. I did C Corps included. I did some 5500s, which means I did some administrative annual informational reports for those that had a retirement plan. I did a couple of nonprofits and their tax return because I was trying to put food on the table. But as I grew, I had so much to do and I was just kind of running out of time in the day. So I thought, well, I better bring on some part-time employees. So I did. And then still continue to grow. I was like, well, maybe I need to bring on a full-time employee. And then it was like, oh, I need to get a bigger office. So all of those things I did in the first 5 years. But when I hit year 5, I started to realize that, okay, if I'm even now going to expand further, I could continue to bring on employees. I could get more space. But is this really the most profitable? And what I looked at was, what's not profitable for me? So I looked at these services and I looked at, well, what's time intensive? What doesn't really bring value? Meaning the client just needs it done. It's not like, oh, wow, you did such a phenomenal job on that payroll tax form. What you're looking at here is, well, what is it that my clients really need from me, want from me? What is it that I'd like to do? What brings the value? And therefore, what should I not continue to provide as a service? And the first thing I lopped off was doing payroll services. And I told all my clients, you know what? We need to get you over to a third party that's all they do. And I wanted to free up time for myself to be able to do more planning, because doing payroll services, can't charge very much for that. Just kind of real true bean counting. 3 for the employee, 1 for the IRS. I mean, it's just bean counting. Now, it's hard bean counting, and people should pay what they should to their advisors that are helping with that. I'm just saying in my practice. So I freed up time for myself, but then I continued to grow, and I hit year 10. I looked around, and I had 5 locations, and we had a lot of employees. And I was like, you know what? What do we need to do to grow? Because do I just want to bring on more locations and bring on more employees? So I looked at, bookkeeping really isn't very profitable. It's just another form of bean counting. It's taking what the clients have brought in and spent and putting it into categories called an income statement and balance sheet. So we took the approach that we wouldn't bring on any new clients that required bookkeeping. They either had to do it themselves or have a third party that was a professional to do it. But see, as I grew, right, when did I know it was time to expand? I was too busy. I was at full capacity. I needed to hire somebody new. But what was that really a symptom of? That I had cash flow that was coming in that was pretty regular. Now, I have a benefit of deadlines and the government that imposes these deadlines, that things have to be, in essence, filed, but it's on an annual basis for most everything. Payroll's quarterly. So when I knew that it was time for me to expand, I then also kind of looked at what I told you earlier, which is, but what's more profitable? And do I really need to expand, or do I need to free up time so that I can just sell more of what is actually most profitable, or second most profitable, or third most profitable? So it's, in essence, not looking at the symptoms. Many small business owners like, I need to get more space. Why? Because I need to hire more employees. Why? Well, because I'm too busy. Okay, those are all symptoms of what? That money's coming in on a regular basis, things that you can count on. So you have to make sure that that actually is happening. Not just, well, it's going to happen when we do this, so therefore I need to hire more employees, and therefore I need to have more space, because those things just bring more costs that can affect, in essence, the viability of your business. Now I'm going to pause here for a minute. Amanda, do we have anything that we need to pop up? Because we're trying to dazzle people a little bit. This is our first time. We've got a logo up right here. Boom. We've got JJ the CPA here. We've had things that have popped up that says, hey, subscribe, thumbs up. I know CSR tells everybody. We've got, what is that? The toolbox that has me with Captain America. It says JJ the CPA. So we've got hand built by JJ, the JJ the CPA small business toolbox. What else we got? What other graphics we got here? We got the toolbox that can show down below. We had some of the things that we talked about. What are some of the little, yeah, that's right. I was supposed to tell everybody I was excited at the beginning so that you could throw this little video. That's kind of a wrench sound, right? And then we don't even need a voiceover, but do the voiceover of subscribe.
Subscribe now. Subscribe now. Subscribe now. Subscribe
now.
That would
probably be something that would be more, maybe CSR would throw that in.
And I think next time whenever you go into story mode, I'll just play some light background.
Oh yeah, throw that up. Would you got any light background music?
So what we could do a little acoustics.
A little daydreaming.
Okay. Then if we're really feeling fancy.
There we go. Yeah, there you go. If you've been a part of this channel, which I bet you have, if you're tuning in, especially if you made it here, which I appreciate you, I love you. In the very beginning, right? I mean, we just threw a camera up. We didn't pay attention to what was on the bottom or on the back. We certainly didn't have any graphics up. This was all fairly new. So this is new to us. And maybe by episode 10, it'll even get a little more like the nightly news, where we might have a graphic that comes up, little pictures and little videos. We can get them coming up like they do on the news, just to, in essence, maybe provide a little more, quote unquote, entertainment value or interest related to this. Now let's get back to our subject matters. I want to talk about, there's about 15, 16 minutes left here, is the best retirement plan for the self-employed. So Let's bring that graphic up if we can on the self-employed. So when we're talking about, well, what is the best plan for the self-employed? Pick them, right? A SEP, a 401k, a simple IRA. They're all doorways that you can put money into. If you said, well, JJ, I'm just going to put away $6,000, but do an IRA. Well, you know what? I really would like to do $8,000. Well, you can do a SEP, 401k, or a simple. Well, what if I wanted to do 13,000? Well, you can do a simple or you can do a 401k. Now, granted, there comes into, well, what is the cost of having these? And that's going to depend on where it is that you have the investments. But when you're looking at the ability to put money into retirement and the ability to get a deduction, all of those provide that. And just for those that are really needing that clarification, when I say IRA, I mean traditional IRA. I didn't say Roth IRA. Roth IRA, you put money in, you don't get a deduction, it grows tax-free, but you pull it out tax-free, okay? So that's a different philosophy. When you're looking at, well, for a self-employed individual that's filing a Schedule C, filing a Schedule F, what is the best plan for them, okay? Now, if you were just to say, JJ, what's the best plan? Just pick one. Tell us what it is, JJ. I'd say 401k with a SEP, because it'd allow you to put in $61,000. How? What are you talking about? Are you going to put in $61,000? That's the first question I'd ask my client. Well, no. How much are you going to put in? Like $5,000. So why are we having a discussion on why you can put in 61 grand when you're only going to put in $5,000? So the point is that the less you're putting in, the simpler the plan, which less cost then to the organization that's setting it up for you. So most of the time with the IRA, let's pull that graphic back up. The IRA might be, $20, 25, 35, $50 annual fee. A simple plan, really probably about the same. 401k could be a little more expensive. It could be a little more expensive if you have to do some testing and some filing with the IRS. Maybe it's $1,500 a year to maintain, set up that plan that you would have to pay to a third-party administrator. A SEP plan's pretty simple, maybe $35, $40. So you see my point? It's like, well, I mean, if these are all pretty cheap, maybe other than the 401k, there really isn't, well, what one's best for the self-employed? Now, the one thing I want you to note is that for the SEP, how did I come up with 12,500? Because with a SEP, you can put up to 61,000. Well, a SEP is limited to 25% of your net income for a self-employed individual. Now let's pull down that graphic, because if you're not 50 or over, then the simple is 14,000, the 401k is 20,500. Now, regardless of your age, the SEP is 25%. So if you were to say, well, JJ, I have 100 grand that I can put into retirement. So what one would be the best plan? Well, you'd have to look and go, well, what did you net on your business? Well, I netted 50 grand. Okay. Well, you can set up a SEP you can put 12,500 into, and you could set up a 401k that you could put up to 20,500. If you're under 50 or 50 or over, you could put 27,000 in. So see, these things are also contingent on your net income. So the IRA is not contingent on your net income per se. Okay. The 401k and the simple plan, if you net $15,000, then you can put 14,000 into a simple, because you can put first fruits into it. What about the 401k? Well, you can put first fruits into that up to 20,500. So when you then say, well, I just need to know what the best is because I don't want anybody to help me, okay, then get a hold of a brokerage house that doesn't charge you to then look at this with you, because the scenario is, what is the net income from your self-employed income? Okay. That is going to be then something of a limitation of what you may be able to put in. Now, if you are netting, pull that graphic back up real quick. So if you're self-employed, Schedule C, Schedule F, and you're netting 50 grand, you can put 25% into the SEP. You're locked at that, which also means if you were netting 100 grand, well, you could put 25,000 into a SEP. If you're netting 200,000, you guessed it, You could put 50,000 into a SEP, and then you can say, oh, well, the SEP must be the best one. Okay. Not necessarily. All it allowed you to do was put more money in. But see, the point is that if you only netted 50 grand, you can only put 12.5 in. You don't judge the plan only by, oh, this one allows me to put in up to 61 grand. So we pull the graphic down. So when I'm talking with a client, we are looking at year to year. Because the thing is that you can have one plan one year and a different plan the next year. Now know this, I'm going to give you a blanket. Okay. For the simple plan, the 401k, you got to talk with your advisors. But typically that's got to be set up by October 1st of the current year to have it for the current year. So if you're going to have a 401k or a simple plan for 2022, you've got to get these set up by October 1st of 2022. Okay. How do I do that? You put money in it, you go to your broker and you say, I want to set up a 401k, or you go to whatever entity is that you're putting your money into, and you say, I need to set up this plan, and then you have it set up. Yes, there's other things to it. You're not going to get all that from a YouTube video. You got to break down at some point and get a professional to help you. My goal here is to, in essence, give you information to take to your advisors. Now, when you have an IRA, right? If you have no earned income, you can't put money in an IRA or a SEP or a 401k or a simple. You got to have income that's earned or self-employed. Now, if you're an S Corp owner, you can still do all of these things. If you're a partner, you can still do all of these things. Now, if you have employees, that can be then a curveball. But I'm telling you right now, for most self-employed, they don't have employees besides themselves. So this is really to focus in on the self-employed, the Schedule C filer, and the Schedule F filer, and when we're talking about these various ones. All right. Lastly, the IRS Alert. I really gave it to you. That's what it is, right? So we have a little sound effect. I don't know. We're going to have to somehow come up with a way to do this better. But what's the sound effect when I say, I think on those, once it plays, it goes off. See, we're working out the kinks on this stuff. So on the IRS Alert, it's just real simple. Keep your receipts. You should have been doing this from the beginning. Keep your receipts in, whether it's a shoebox or manila folders, or you're scanning them, or you have PDF. But when you are potentially selected for audit, knock on wood, you need to have receipts to back up your expenses. So when you go out to eat, or you're buying office equipment or something at Apple, or you're paying a membership fee or dues, or you're streaming Apple Music into your waiting room and you're paying the monthly amount, you need to have receipts related to that. You don't get to grumble and complain and how that's so unfair. And you really are I'm really expecting you to have receipts, because the IRS is going to need proof that that is a business expense, and bank statements and credit card statements don't count. Now, I understand you could say, well, what do you mean? I'm showing a check right here that was made payable to Office Supplies. What else would I have bought at Office Max or Office Depot? It would have been Office Supplies. IRS is like, oh, I'm happy for you that you can show me a check that's payable to Office Depot. Good for you. Exciting. But I need the receipt to know what it is that you bought. Did you buy a bunch of Werther's candies and you really took them home, or did you put them into the office? Did you just buy toilet paper and take it home? So you got to have the receipt. Right? Same thing when you go out to eat. Same thing when you're buying anything. Now, the big thing I want to use when talking about this is that with the IRS, when you're looking at, well, what is an expense I can write off? You look at Code Section 162, and there's two things that you have to achieve to be able to write it off. But regardless of, well, what are those two things that I have to achieve to be able to write it off? You still got to be able to prove it. And how do you prove it? With the receipt. And I've sat with clients that are like, yeah, but the receipt stayed, so I don't worry about keeping them. What? I mean, that's, you know what? My driver's license, I might lose it, so I didn't get one, right? I mean, that doesn't compute when we're talking about an authority that we must report to, right? Or prove something to. You have to have the receipt. If you're worried about it fading, what I told that client is, well, then you need to scan them, or you need to get them to PDF, or get yourself some kind of an app that scans them. I don't have any apps that I endorse at this time. Good old-fashioned PDF works. You can scan and have a PDF and attach it to your expenses if you're using QuickBooks. I'll just tell you what I have is, well, I won't make it noisy, but if you're just to pull this drawer out, I just have a series of manila envelopes or manila folders. And I have in a, well, I'm just going to do it. So I'm just going to show you this example. So here is a file, okay? And as an example, everything in this blue file would be related to the credit card that I'm going to use, let's say, for the business. And this would be for January's receipts, February's receipts, March's receipts, and I would have the credit card statement in there. That's simple. Yeah, is it old-fashioned? Yeah, sure. Why not? Who cares? I've got storage where it goes, and it's not going to get burned up, some of the stuff we scan. But it can be that crude, if you will. If you want to get sophisticated, I think it's great. I have clients that they're going to do that same thing, and instead of it being in a manila folder, it's going to be in a virtual folder, but have all the receipts that then back up what's on the credit card statement. Then you would have another, in essence, one of these that would be, well, here's my bank statement. You know, maybe it's completely different. And in January, you have your own manila with its receipts. In February, its own receipts. And that's just what I've had since I've started my practice, 25 years ago. And most clients are my age, and they kind of just do it the same way. Yes. Who doesn't need? Gosh, this is a trick question. Who? Oh, who doesn't need? That's right. Thank you very much. Yeah, that's right. Yeah, that's right. So with our clients, we don't need those receipts. We don't ask for those receipts because our clients sign a letter with us. It's called an engagement letter that says that if they're presenting business expenses to them, we can trust them. The IRS, they're going to need proof in the event of audit. Now, I want to just go quickly back to Code Section 162. The two requirements for something to be a business expense is that it's ordinary and necessary for your business, and your intent was for business purpose. Well, if you don't have a receipt, how can you even show what the expense is to even show if it's ordinary or necessary? And if you don't have the receipt, how are you even going to show what your intent was, meaning it was for business purposes? So I can have a business and they're writing off pink ballet shoes, but guess what it is? A dance studio. I can have a client and they're writing off knives and forks and napkins and bowls and mattresses and bathroom wear. Well, they have an Airbnb, they have a rental property and they're renting those things out. Those would be ordinary, necessary for the business. The intent of only buying those was for business purposes. And then you have a receipt to back all of that up. Now, I know I did not get through the core of what it was that we were going to talk about in the first 5 minutes, but we are rounding out that we are going to be wrapping up here at the hour mark. So I'm going to let you know that I would love it if you would subscribe to my channel. I feel we've done a few things today. One of the things we might do is crank up the air starting at 9 a.m. to get it about 50 degrees in here. We also have lots of lights here. But I want to thank you for tuning in today. Every Monday, we're going to be having the Small Business Toolbox by JJ the CPA. The channel that I have for you is focused in on small business owners, the self-employed, that is really then looking for information to take to their advisors or to take it to the next level. You probably have found that during tax season, I didn't have a lot of videos out there because the kind of videos that probably are more beneficial during tax season is, how do I fill out this form and let's go through each line item? You can probably find some other people, but see, that's on YouTube that might be able to provide that to you. But I find that that's a little dangerous on here's how you fill out a form, that there could be so many variables. When it was PPP and the tax credits and ERTC, EIDL, it's like, well, there's really kind of a very narrow scope of what we're dealing with. But what you need to do is gather up this information and other resources and meet with your advisor on a regular basis. So what I'm doing right now is getting in touch with my clients. Now, tax season, I got really everybody done. Got a ton of tax returns done during tax season. And I've only got a handful that I have left, which means that I'm able to spend now the rest of the year doing planning. And so I've been getting out to see my clients and say, what's the year going to look like? What are some things that we need to be starting to plan for and think ahead? So use that for these purposes. And if you will, I'd love it if you give me a thumbs up. Thanks for tuning in to the live. If you're watching this later, thanks so much for tuning into this. I'm going to have other videos that will come out, not just the live, so be paying attention to those. But I'll end it by saying you've never met anybody quite like you. You've never met a small business owner quite like you. You've never met a self-employed individual, a team member, a mom, a dad, a grandparent, a son or a daughter quite like you. And you've never met a CPA quite like me. All right. Hey, boom. Thanks for tuning in. And why don't we end it? I want to see that little the video, our opening video that you made where the toolbox opens.
The combination to money making, we got this. JJ, the CPA, is the master locksmith.
Boom. All right. With that, we are out. Thank you for everybody joining in. Hey, real quick, I'll turn the mic to you, though. We're done with the show. But who, anybody want to throw some shout outs to? We probably should have done that maybe after I did my 5 minutes.
Oh, well, we'll say hi to Rob from Measurement Toys.
Rob, how are you, sir?
And CSR. And
Stacy.
Stacy Slater was on.
Stacy, how are you?
And Greg was on.
Love it. Thank you, Greg.
Brian from Group 50 was on.
Thank you, Brian. Yes, Group 51. Good representation today.
Clay.
And Clay, how are you?
And Brent Richards and Denisha Avery.
Brent and Denisha, thank you.
And Kevin.
All right. We'll look forward to seeing you each Monday, 4 p.m. Central Standard Time. We're going to get better and cleaner at this. So we appreciate you sticking around and stay with us as we continue this move forward. All right. Trying to time it out. 5, 4, 3, 2, 1. How do we end it? I got to say bye and just look at the camera.
Pretty much.
Okay.